The stars are aligned for India bonds. While much of the world grapples with economic slowdown, India shines as a bright spot. This is evidenced by the surge in India's service exports, a pivotal driver for a shrinking current account deficit. This trend in turn bolsters the Indian rupee. Furthermore, India has a robust foreign exchange reserves exceeding $600 billion. This substantial reserve acts as a formidable anchor for the Indian rupee stability. India's economic outlook remains solid, accompanied by the stabilization in inflation. Furthermore, both India and the rest of the world are poised for the end of the monetary tightening cycle, adding to the appeal of India bonds. Perhaps the most significant catalyst for India bonds is their inclusion into JP Morgan Global Index. This inclusion begins on June 2024 and will happen in 10 monthly increments of 1 percentage points each, attracting an estimated influx of $20 to $25 billion from index tracking funds. Active managers are also expected to join the fray, enticed by higher yields and lower volatility for India bonds. Beyond JP Morgan, other index providers such as Bloomberg and FTSE are considering the inclusion of India bonds into their indices as well. This shift could mark a turning point in India's government bonds where historically supply outpaced demand. With increased foreign inflows, the demand for India government bonds could finally outstrip supply, thereby driving bond yields lower. Consequently, this move is likely to reduce government borrowing costs and also improve India's credit ratings. These larger inflows will significantly ease India's ability to finance its current account deficit while reducing the pressure on the Indian rupee. In the near term, the Indian rupee would be affected by higher US rates and oil prices, which will provide an incentive to consider India bonds now. With expected inflows for India bonds and the Reserve Bank of India likely to smooth the pace of Indian rupee depreciation, significant downside for the currency is therefore limited. India bonds can provide a strong anchor for global investors in uncertain times. Let me hand the time over to George to share more about how to tap into the India bond market.
Do you know that India's bond market is one of the largest in the emerging market world in terms of market capitalization? Global investors can gain exposure to India's expanding opportunities by investing in its sizable and very liquid domestic bond market, which is now at over $2.3 trillion. We believe the inclusion of India bonds into global indexes is a game changer. India is currently being considered for the Bloomberg Global Aggregate and FTSE Index inclusion, which could potentially be multiple times larger than the JP Morgan Index inclusion. Active emerging market fund managers will try to position themselves ahead of the passive money before the actual inclusion takes place. So, as global investors become more and more comfortable and more familiar with the India bond market, they are likely to broaden out from government bonds and look towards corporate issuers. The case for India bonds is very compelling. India bonds can play a dual role in your portfolios, as a diversification tool and as a yield enhancer. Currently, India's 10-year government bonds yield is over 7%, offering a substantial 3 to 4% more than their developed markets counterparts. Additionally, India bonds have higher yields compared to many other emerging markets. Moreover, India bonds have exhibited a low correlation with global bonds over the last decade. This is because of India's unique growth dynamics, setting it apart from the rest of the world. Importantly, the India bond market allows investors to access high yields in a relatively uncorrelated and large emerging market. By incorporating India bonds into portfolios, investors can elevate overall yield and enhance diversification. To harness these benefits effectively, a well-diversified portfolio of India bonds ranging from government and quasi-sovereign bonds to high-quality corporate bonds is essential. In conclusion, investors should consider India bonds as they present an attractive opportunity for both yield enhancement and diversification within a global bond portfolio. Thank you.